Hello, welcome. My name is Seewing Yee and from the Yee Real Estate Network. Thank you for attending. And today's topic is income property, the, the world's most powerful wealth building vehicle in history, really. All right. So without further ado, let me share my screen and let's get started. And for many years, over 20 years of doing this business, I have assisted thousands of real estate investors to buy income properties to achieve their wealth for themselves and their family. So, and I always try to think of new ways to educate and inform real estate investors out there. So today I put together a presentation, which I feel confidently and strongly that from a high level, this is really, it'll resonate. You will get it. I'm going to provide you with a big picture why investing in real estate, buying income properties will achieve generational wealth for you and your family. So yeah, so anyway, without further ado, let's get us started, all right? And although I'm using the example of this particular property, $385,000, it could be a $50,000 investment property. It could be a $100,000 investment property, or 150 or 200,000. All right, so I'm just using a generic example. Everything is based on assumptions and based on my experience of working with thousands of real estate investors over more than two decades in consulting. All right, so without further ado, let's get started. I think you're gonna like it, all right? And the numbers, you may not be able to see that well, but do your best. All right, this property is a single family home, $385,000, all right? So as an investor, you are not a owner-occupied buyer. You are not a first-time primary home buyers. You're not a newbie, right? You are a true real estate investor. So you have armed yourself with 20 or 25% down payment to trigger your action plan to buy your investment property. All right. So without further ado, here are the first year projection. I'm giving you some very holistic, big picture. Not only a first year return on your investment when you do the numbers. You have to do the math, right? Doing the math is critical for you to achieve wealth through income property investing. So with that in mind, so $385,000, you can put 25% down payment. So your total down payment is a little bit more than $100,000, including closing costs. All right. And so, by the way, this is a real example. Again, I'm not going to go through specifics as to what location, whatever. You can learn more about that through other means. But again, even though I'm using this purchase price, it could be any purchase price, as long as typically it's a single family home investing, duplex, triplex, fourplex. That would be ideal because you can qualify for the favorable Fannie Mae lending guidelines for investors, right? So with that in mind, so you have to ask yourself, your only risk initially is your down payment, right? So let's let's go through the process. The monthly rent is estimated to be $2,500. So these are very, very good rent to value ratio, as indicated on the upper right-hand corner. The financial indicators, 0.6% rent to value ratio is a very good metric. The other metric, I'm not going to go through too much detail on this presentation. The capitalization rate is 5.4%. Cash on cash return initially is 2%. Total return on investment is around 25% first year. This is a first year projection. Now, too many investors, they only look at the first year projection to make an informed decision. I'm going to show you, you need to look at beyond the cash flow, beyond the first year projection. I'm going to go through a 10-year projection. So just bear with me. I will go over that. I will go over the 10-year projection and you will see holistically how how this is very attractive. All right. So let's go to the numbers. $2,500 monthly gross rent, and then you minus, your typical monthly property taxes. In this case, 417, insurance 100, property management fee, assuming you're going to use a professional property management, typically 8% of the rent, and then the operating expenses. Then you can get a 6% investment loan mortgage. Now, the interest rate. I know there's been a lot of challenges. It's either here or there. I mean, it's just a lot of different kind of assumptions. Hopefully, the interest rate is going to be lower. So even at 6% interest rate, mortgage rate is still a historical low, believe it or not. Remember, if you do not remember, maybe your parents bought a house back in the 1980s, and at that time, the highest mortgage interest rate at that time is around 18%. That's right. I did not stutter. All right, with that said, even at a 6% interest rate, it's okay to take action, right? Because your monthly mortgage is your loan amount is, as you can see right here, $288,000. So your monthly mortgage is around $1,550. So your gross rent of $2,500 minus your operating expenses right here, right? And plus your monthly mortgage of $1,550, you're still going to have a positive cash flow of approximately monthly of a little bit less than $200. Now, some of you are thinking, oh, I want more cash flow. Well, it is what it is, right? I mean, you have to deal with the reality of the real estate market at this time, but we all want to be higher, but again, the interest rate is a little bit higher, but don't despair, all right? I will show you from a math perspective over the next 10 years how this minimal initial cash flow will be mitigated by other ways of making money on this one rental property. I say it again, do not think, at least you're getting a slight monthly cash flow. That's fine, much better than negative cash flow. So, okay, the assumption is the numbers make sense, all right? So let's all agree on that, holistically speaking. All right, then yeah, a couple $100 monthly cash flow, that's fine. All right, that's the first year. And then, okay, here's the beauty of long-term investing. So as a risk investor, you need to think about investing for the long haul, all right? Okay, don't worry about the short-term volatility or the negative headlines or doom and gloom, all those kind of scenarios, the economy, whatever. Control your personal economy, control your goals, your objective, focus on your action plan. You need to don't get distracted by all the noise out there. All right, focus on your financial goals, on your wealth building vehicles, and you'll be fine. All right, show discipline, show commitment. Don't panic. You just stay the course. All those positive attributes that each real estate investor need to have. All right, so let's go over the tenure projection, and this is the fun part, right? You really need to pay attention. If you need to replay this video more than once, multiple times, you'll get it, right? Just like watching a good movie, at the end of you watch it the first time, then you may not get all the information, but when you watch the second or the third time of a good movie, you really get it. So this video presentation are no different. If you don't get it watching the first time, watch it again, multiple times, and hopefully your light bulb will click, right? It's a light bulb moment. All right, so let's continue. So the assumptions that I use is this investment property, your rental property, will increase at an annual appreciation rate of 6%. That's the assumption that I make. And the assumption I also make is your rental income will increase every year by 6% also, which is in line with inflation, right? So if inflation is 6%, whatever, you should raise your rent at that particular time in time at around 6%. So the assumption I'm making on this 10-year projection, 6% appreciation rate annually, and then 6% rental rent, you can raise your rent, at a 6% on an annual basis, which is pretty realistic given what's going on with the past. So so if you look at the end of the first year at $2,500 monthly rent, multiplied by 12 months, at the end of the year one, you can have a total gross revenue, gross rent of $30,000. See that? And then if you look at the year 2, 3, 4, 5, 6, 7, 8, again, these are only assumptions. But if you increase your rent at a rate of 6% per each annually, so your second year of annual rent, gross rent, from 30,000 to 31,500, third year from 31,500 to 33,000, and so forth and so on. At the end of the 10th year, your gross rent at the 10th year mark is a whopping 46,540, right? That's your gross revenue before expenses, mortgage, and debt obligations. Okay, bear with me. Then you minus your, typically maybe 5% vacancy, and then your gross rent minus your vacancy equals operating income, right? Then you go over the expenses. Your property taxes, it's going to rise over time, cost of living, all those kind of things. So as you can see, the property tax will rise from an annual first year 5,000 systematically based on 5% increases of the taxes. As you can see, the tax increases on your house. And then insurance, a slight increase as well from initial first year of 1,200 until then, as you can see, it increases, right? And same thing with property management fee and so forth and so on. So then your operating expenses at the end of each year is accordingly, as you can see right here, right? Now, right, so far so good, right? So right now we have reached the operating income stage. Now let's look at the next slide, which will go over the income analysis, right? And this is where it gets good. The income analysis is very, very interesting. So now we are reaching the point of operating income, net operating income on an annual to annual basis, as you can see, increasing. Then you minus your mortgage payment. Guess what? Your mortgage, your loan, your fixed rate 30-year loan, as you can see, never increases, right? So your mortgage loan is a tremendous wealth building vehicle. Is a great, good debt, is a hedge against inflation. Is an amazing 30-year fixed rate. And then, right, then at the end of the first year, your net operating income minus your mortgage payment equals your annual net cash flow. At the end of the first year, your net cash flow is around 2,200. At a 6% rate increase, you see the annual rental cash flow, right? You complain about the low initial net cash flow of less than 200 per month, right? As we went over the example. You look at the second, third, fourth, and fifth year, you see the systematic growth of your monthly net cash flow because you're going to increase your rent, that's how, that's historical, right? So inflation and cost of living, you're going to raise your rent. So your cash flow will get higher at the end of the 10th year from a $2,200 annual net cash flow at the first year. At the end of the 10th year, as you can see, your cash flow is much, much higher. All right, so that's a good sign. See, that's what I said. Just don't focus on the cash flow. We all want higher cash flow at first year projection, but it's all about investing over time. And then at a 6% appreciation each year, your property will appreciate based on the assumption 6%. See, at the end of the first year, your property will grow by 23 grand. Second year, another 24,000. Third year, almost 26,000. And at the end of 10th year, right, we're talking like $38,000 annually. So each year you can gain those equity appreciation. All right, and then let's go on and then your cash on cash return, right, it gets higher every year. Your capitalization rate will kind of stay the same, your cap rate. Then you return your equity, right, which is very, very good. And then let's go with the next category, the loan analysis, right? Based on 6% appreciation, you purchase this income property for $385K At the end of the first year, at 6% equity increase appreciation rate. At the end of the first year, the value of your home is 408. At the end of the second year, right, do the compound interest, which I will discuss that a bit later on this presentation, at another assumption of 6% interest appreciation rate. So your house at the end of the second year will become 432. At the third year, let me look at closer. Third year is 458K, fourth year 486K. At the end of the 10th year, your value of your property is a whopping 689,000. You bought it for 385K. At the end of the 10th year, your market value of your house equals 689, almost $700,000 based on 6% appreciation rate. Okay, keep that in mind. And we have not even gone beyond 10th year, right? Okay, we just talked about the first 10 years. Look how much return overall you're getting. Then your loan balance, here look at the loan balance, right? That's the beauty. Your tenant is gonna make you rich, right? So systematically, the rent you're collecting is that you're gonna amortize your loan. It's gonna lower your principal, right? That's the key. Each year, when you collect the rent, the rental income gonna pay down your mortgage, your principal, and your interest systematically speaking. So initially, right, you have a loan of $280-something thousand. You see the loan balance decreasing on year by year. At the end of the fifth year, it decreases to 265,000, right? At the end of the 10th year, your loan becomes 234,000, right? So increasing market value, right? And decreasing low balance. So therefore, I know there was some, throughout history, there will be some down years, right? I can't factor that in on this presentation, but yeah, we see a slight correction, a slight reset, as we're seeing right now, even in today, year 2022. But then again, I can only use assumptions based on historical past performance, right? And of course, no one can predict the future, okay? And so no one have a crystal ball, and this is just an illustration. This video presentation is just a projection, right? So increasing market value from year to year, right? Increasing market value and decreasing low balance equal your equity, right? Your market value of your house minus your loan balance equal net equity. As you can see, net equity systematically grows from initial of 123,000, then second year 152, third year on and on is higher to the point where at the end of 10th year, your equity total is around 454,000 based on 6% annual appreciation rate. So far so good. All right, so and then the next acronym you need to know is that loan to value. It's called another word for LTV, right? Loan to value. So in this case, your loan to value, because you already put down 25% down payment with the rising market value of your home over time, and then the decreasing debt amount, loan balance, that is, the lower your loan to value ratio, that means you have the ability at any given point for the next 10 years, right? If your low LTV, anytime your LTV is less than 75% or 70%, you have the ability to do a cash out refinance, right? When you do a cash out refinance, it's a tax-free transaction because you just refinanced your loan. There's no tax implication. But again, consult your tax advisor. So you have the ability, if you want to, at any given time between the first and 10th year, as you can see, the potential cash out refinance is all like the third year, like 40-something thousand. At the fifth year, almost 100,000 amount you can cash out refinance because you have a low DT LTV, that is loan to value ratio, right? So again, some of the extra strategies you can perform throughout the ownership of this rental property is that if based on your goals and objective, right, you can cash out refinance, tax-free transaction. And for example, at the 5th year, you already have almost $95,000 ability to cash out refinance. So the only way I would recommend you can refinance this 95 grand at the end of 5th year, or any year for really for that matter, is to you can leverage to buy more property. This 95 grand can buy you 1, 2, or 3 more rental properties. That's how you leverage. That's how you scale your real estate portfolio, right? You can leverage against the equity, refinance against the equity of 1 or more investment property that you own, so you can buy more rental properties. The more rental property you can buy over time, the more property you have, the more you can scale your real estate portfolio. Do the math, right? It's very, very simple. It's not rocket science. The more property you have, if you own over time, you started with 1, 2, or 3, 4 property, given your financial resources you have, and at 3rd, 4th, and 5th year, you can cash out refinance to buy 2 or 3 more. You leverage 2 or 3 more rental property from each of your property, as given in this example, right? Before you know it, in the next 10 to 20 years, you can own 10, 20, or 30 investment properties, right? If you allow a great professional property management to manage your property, I mean, the total time you can spend managing your property is maybe 1 to 2 hours per month. You do it passively, remotely, and rely on your team on the ground in a market that you have purchased. Assuming you purchase a good market in somewhere in South, in the Southeast, or the Midwest, whatever. Then you can delegate, and your property management will do all the work for you. You can so you can really make your money work smart. You don't work hard for your money. You work passively, remote. Getting your money in your mailbox. With very little work, very little work from your effort. Whether you own 1 property, 10 investment property, or 20 properties, as long as you use the right system, okay, right turnkey system. All right. So finally, on the sales analysis, if you were to sell your investment property from anywhere from year 1 to year 10, you just do the math, right? Based on the 6% annual appreciation rate, as you can see, the equity, right? Equity will increase, systematically from year to year, as you can see right here. That if you will sell the property in any one of this timeline, right? Then, as you can see, you minus the sales commission, closing costs, you can have a proceed after sale. Proceed after sale is your gross profit, right? Then all the annual cash flow, all the monthly and annual cash flow you have collected over time equals all these numbers right here, right? A lot of cash flow, a lot of equity appreciation, and but you only put in, all you put in is your down payment. That's it, and your 100 grand, whatever, right? See the power of compounding, the power of investing for the long term. Now you see how the numbers work. Your initial investment, you thought, at the beginning, 100 grand is a lot of money. But if you factor in 5 to 10 years to 15 years down the road, your return, overall return on investment is 10x or more, right? So you gotta have a long-term perspective, okay? Anyway, so your net profit, right? If you will sell it minus cost is or this particular amount. Now, I mean, yeah, again, I'm not a tax advisor, consult one to go over your situation, but the net profit is subject to taxation, right? If you outright sell your investment property, you have to pay capital gains tax. But then again, if you do if you have a long-term investment horizon, you can do a 1031 tax-deferred exchange, right? If you get the net profit, as you can see right here, whatever it is, 96,000 here. If you sell it at the end of the 4th year, you will sell it at the end of the 7th year, you could have a net profit of 225K. They're subject to capital gains tax. However, if you do a 1031, if you sell this property, do a 1031 tax-deferred exchange, and you buy a replacement property, and your capital gain tax will be deferred, right? And then you can buy on a 1031, if you were to sell your property, not paying, delaying your capital gains tax, but you can leverage, you can exchange from one property to 5, one property to 10, or whatever the case may be, right? So another way, 1031 exchange, another exit strategy, you can leverage your real estate portfolio is you can scale your portfolio to buy more properties, to buy, commercial property or multi-unit or apartment building or fourplex, whatever, through a 1031 or through a cash out refinance, either or. Does that make sense? I hope it does. All right, and then that's pretty much it. Now you see the power of long-term investing if you have the commitment and the discipline, to stay the course and not, worry about, the short-term, doom and gloom scenarios, volatility, whatever is out there, right? Right. So, and then my next presentation is, it's amazing, right? In real estate investing, there are no other asset class where you can leverage, where you can get a loan against it. Not the stock market, not mutual funds, not bonds, not crypto, not whatever out there, whatever alternative investment you have out there. In income property, you have the ability to leverage, right? To get an amazing 30-year fixed rate mortgage. Your 30-year fixed rate mortgage is a hedge against inflation. It's the 8th wonder of the world, dare I call it. I mean, the greatest invention since apple pie, sliced cheese, whatever, all right? So if you use this 30-year fixed rate mortgage on your income property, it'll change the trajectory of your financial future, right? Because your payments is fixed, right? Regardless of the inflation, regardless of cost of living and everything else, and just let your tenant, let your cash flow systematically amortize and pay down your loan, right? It is another definition of fixed rate mortgage as applied to your income property is a inflation-induced debt destruction, right? This is that good debt. If you use this kind of good debt, if you use this 30-year fixed rate mortgage, good debt, multiple times over, you and your family and your legacy will be changed forever, generationally, right? The power of the 30-year fixed rate mortgage. Get it, do it, and your life will change forever. And then the rule of 72. The rule of 72 is a 8th wonder of the world, as you can see at the bottom, right? The rule of 72 divided by your interest rate, which is in this case of the income property, is your annual appreciation rate that I already projected in this assumption to be 6%. Okay, so how many years it take for your property to double, years to double your money based on your appreciation rate divided by 72. So in my case, in our case, we're using 6%, right? It could be more, it could be less, right? I'm going to use the historical standard, right? So 72 divided by 6% annual appreciation rate. So your property will double in 12 years, right? Okay, let's follow up with the math. Using the same example on this particular property, the purchase price of this property is $385K at 6% annual appreciation. So 72 divided by 6 equals 12 years. In 12 years, the $385K will become $770,000. Think about it. 12 years is not very long, right? It goes by in a flash. So if you buy real estate and wait, instead of wait to buy real estate, you're gonna reap the fruits of your labor. All right. So again, this 385K will become 770K at 6% appreciation rate using the rule 72. Guess what? This is just a beginning. This is just a tip of the iceberg. 12 more years beyond the initial 12 years. In 24 years, assuming, I know this is just an assumption, your property will continue to appreciate at a rate of 6%. Guess what? The magic of compound interest. The $770,000 property in 12 years will become what? Multiplied by 2, become approximately $1.5 million in 24 years. Let's sink in for a moment. You bought the property today, 2022, at $385K or whatever the amount is, right? In 24 years from now, 22 plus 24 at the year 2048, right? No, 2046, 24 years later from today, your 385K property becomes 1.5 million, right? I know this is inflation, cost of living, all those kind of things all factor in. But imagine if you bought more than one income property, how many, you can do the math, do the 10x, do the multiples. So the power of the Rule 32, the magic of compound interest is an eighth wonder of the world, all right? And finally, for the remaining 5 minutes, I say it again, one more time. Your income property is history's most powerful and proven multi-dimensional real estate asset class. That's a mouthful, isn't it? Right? You're making money in 5 different ways, right? Don't worry about if you have a low cash flow. Yeah, you can go to the Midwest and buy higher cash flow. That's fine, right? But I'm just giving you this one example. Don't worry about the low monthly positive cash flow. There's only one component of your investment, right? You're getting income, you're getting cash flow on a monthly basis positively, right? Right, because your renter is making you rich, your renter, your tenant. And then your property, again, I'm not a tax advisor, so don't quote me, consult your tax situation with your advisors. But you can potentially, as an income property, you get the depreciation tax benefit, a phantom write-off, a paper write-off over time, over the next 27.5 years, whatever, right? So you can pay less income taxes from the money that you make every year from your income property, right? Right. So great tax benefit is income property is one of the world in history's most tax favored investment that other asset class are not going to get you or not getting that, right? So equity growth, which is appreciation, right? Over time, yes, there are some fluctuations from time to time in the course of history, but over the long term, yeah, there's an up and down aspect of real estate, just like anything else, right? But over time, if you invest for 10, 20 years or beyond, you're gonna make money, right? That's a given. You look at history, you look at other investments that have done well. And of course, appreciation, same thing as equity growth. And leverage, right? Again, OPM, other people's money. Other people's money, right? You're able to put 20 to 25% down payment and leverage the rest of the investment to a lender, right? Isn't that powerful? So you're only risking 25%, 20 to 25% of the asset. That's it, right? Because you have good credit, you're using the power of leverage, other people's money, right, to finance your mortgage. When you use a mortgage, when you leverage your asset, when you leverage your income property, your rate of return is much higher, right? I mean, that's a given. All right, I think that concludes my presentation. In review, okay, when you buy investment property, you have to buy in a good market and a good property that can achieve positive cash flow with 20 to 25% down payment, right? That's the trigger, right? And then use a turnkey system, hopefully, use a professional property management to help you over time. You can scale your investment using leverage, using cash out refinance, using 1031 tax-free exchange. And even if you do not use 1031 tax-free exchange or cash out refinance your property, you can pay out your mortgage, right? Maybe you could even pay one extra principal per month on each of your mortgages. You can pay it off. You can accelerate your debt. You can accelerate your mortgage. You can pay off your mortgage in about 7 to 10 years instead of typical 30 years. Therefore, you have no debt in less than 10 years. So you can live off very high passive income per property. If that's what you want, I don't, each situation is different, right? So, and what if, okay, once you remember I said real estate income property is you build wealth, is a generational wealth building. Now, let me give you a prime example. Let's say you keep your property for the rest of your life, okay? You gain all the equity, all the cash flow, everything else. You never sell your property, right? But by the way, when you pass with all your properties in your possession, you get what the tax law will give you a step up in basis. That means at the date of passing, all your assets, whether it's stocks and bonds or whatever, and real estate are no different. Your property will at the time of passing, the property will be step up to the market value. So there's no taxation. It's tax-free. Of course, when you pass your assets to your beneficiaries, your estate, they have to pay some kind of taxes or whatever. But imagine building your wealth, achieving years of cash flow and equity appreciation, and when you pass, your property get bumped up to at market fair market value at the time of death, right? You don't pay your estate, or not going to pay capital gains tax or ordinary income taxation, nothing like that. It's a sort of a tax-free transfer to your loved ones, if you will. Again, I'm not an attorney, I'm not an estate planning attorney, consult your financial advisor, but I'm just telling you, again, I know this presentation is longer than usual, but this is a blueprint. This presentation, it took me a lot of years to put together, okay, in a 25-minute format, whatever, right? I believe, come to think about it, this is one of my most important video ever that I've done in the past 20 years, or in this business. So again, to recap, income property is a world's greatest historically proven multi-dimensional asset class. You can make money in multiple ways: passive income, tax benefits, equity appreciation, and using your leverage, paying down your mortgage. The renter gonna make you rich, all those kind of things. So that's it. I mean, there's nothing else I need to say. All right. So that's all. Hopefully, this. I do not believe you have gotten this kind of information, this topic, the way I explain it in any other venues, right? So hopefully you receive a lot of value from this, and thank you for attending, and good luck in your financial future. My name is Seewing Yee from the Yee Real Estate Network. Thank you for attending. Good luck, and I'll see you on the other side. Have a nice day. Bye-bye.